Good morning, viewers. Welcome to the Q1 2025 Global Dashboard. I am Brunette Gasson, COO at Catalyst Fund Managers, and this morning I'm joined by Gugun Langiza, an investment analyst of our global listed property capabilities. Gugs, it's been a bloodbath out there. Luckily, you and I have had a weekend to recover. But viewers, alongside all of you, we are also navigating all this market volatility and the uncertainty that goes with it. And this time, a lot of it is due to Trump and his combined tariff policies. Now, we saw the S&P in the last two trading days fall by roughly 10.5%. But as you know, we focus on global listed property. So let's unpack what the primary risk is in our environment, and that would be higher inflation, which would lead to higher bond yields. Gooks, let's unpack that to kickstart this day.
Sure. I think most investors are acutely aware of the environment that we find ourselves in. And I think, one of the first order consequences of higher tariffs is an upward pressure on inflation, particularly for the country that's imposing tariffs, right? And that naturally results in higher nominal bond yields to compensate for the loss in purchasing power, assuming that real yields remain unchanged, right? That said, I think, most people will agree that we are in an environment that's characterized by meaningfully pronounced uncertainty. And to your point, President Trump's, tariff policy is a major concern that is top of mind across the investing community. And I think largely due to the fact that it's difficult to gauge the second order consequences of his policy. For example, we don't know, how the tariffed countries are going to respond. And also it's difficult to gauge how, monetary or fiscal policies are going to be adjusted in response to, higher tariffs, reciprocal tariffs, and most importantly, how the interplay of all these factors is going to impact or influence how investors are thinking about the evolution of economic growth prospects in the foreseeable future.
Good. So in this crazy volatile environment, in your opinion, would you say that global listed property can be seen by investors as a resilient investment?
Sure. I mean, my bias aside, I think it's important, especially in periods where, you are navigating an environment that has meaningfully elevated uncertainty, to look at the fundamentals, right? I mean, to your point, global listed real estate as an asset class is enjoying very healthy operating fundamentals, and that is largely underpinned by a favorable supply-demand backdrop. So on the demand side of the equation, you have these secular structural tailwinds that are less sensitive to economic cycles. And then on the supply side, you have this muted or subdued supply growth outlook, the combination of which is an enviable, position from a pricing power standpoint, particularly for landlords that own above average quality properties in markets with superior demographic attributes.
Googs, in this environment, a lot of people will be comparing global listed property to global equities. And we've been beating the drum that global listed property gives you a lot more, or there's a lot more stability in your earnings growth, relatively speaking, to general equities. And that's often underappreciated by the market, but hopefully in this volatile environment, people will actually appreciate it a bit more. Can you unpack that for our viewers in a little bit more detail?
Sure. Burnett, I think, what we appreciate about real estate as a sector is the ample visibility that it provides investors in terms of forecasting the evolution of in-place rental income. And that's largely premised on, the pre-agreed contractual leases of varying lease lengths across different property sectors, right? And that inherently provides investors with, ample visibility, as you rightly point out, predictability and stability of, the evolution of operating income growth over your forecasting horizon. Whereas if you compare that against general equities, there is a lot of variability in terms of how earnings evolve from a forward-looking standpoint. That is particularly due to, sectors, or rather high growth sectors, that are more sensitive to economic cycles or changing market conditions. So again, the visibility that the asset class provides investors sort of narrows down the range or the dispersion of possible earnings outcomes over your forecasting horizon. And I think if you look at the first quarter share price performance, just looking at the US REITs versus the S&P 500 just for the first quarter of 2025, you could say that investors are beginning to appreciate, the stability or, visibility of future rental income growth in the asset class versus general equities.
Because you alluded to earlier that when we talk about operating fundamentals in property, it kind of boils down to supply and demand, right? So in our global universe, you're sitting with roughly, let's say, 17 odd subsectors, and there are many subsectors where the demand drivers are often less sensitive to market cycles, right? They've got other drivers that are very strong. And one of our key subsectors that I'd like you to touch on is single family rentals, where we know there's a strong demand driver. For the demand there is demographics. Can you touch on that, please?
Sure. I think single family rentals as a sector is one of, the classic examples of, sort of characterizes the healthy operating fundamentals that we are seeing across the asset class, broadly speaking. So if you unpack the supply-demand dynamics, I guess from a supply standpoint, we saw supply, precipitously decline subsequent to the global financial crisis. And, albeit supply has been growing, but at a moderated pace compared to, the growing cohort of aging millennials that need, bigger residential space, and most importantly, affordable residential space as they raise their families, right? So the growing cohort of aging millennials, to your point, is a structural tailwind that we think is going to continue to support demand for, single family rental options. And on the supply side, I guess from a forward-looking standpoint, we believe that, supply is, admittedly, supply is growing in some markets. But that said, I think, construction cost inflation with President Trump's tariff policy, that's just going to, keep construction cost inflation elevated, which, consequently is going to sort of act as a lead on supply growth in the foreseeable future. And that, will sort of preserve, the supply-demand imbalance that we've been seeing in the sector going forward. And I think it's going to, be an advantageous environment for the incumbent landlords like Invitation Homes, like American Homes for Rent. As we've seen over the past, 5-6 years, they've been reporting, sector-leading same property net operating income growth.
Gooks, let's turn to another sector or another subsector within our global listed property universe, and that's data centers. Now, we recently saw DeepSeek's impact on that specific sector and causing a lot of concern about the outlook for the data center subsector. So can you touch on that for us a little bit? Like, what do you see data centers looking like right now? How's it performing, and what's your outlook for that subsector?
So the data center sector is enjoying a very strong operating environment as it stands. So you have, from a demand side of the equation, you have these tech giants like Amazon, Google, Meta, proactively spending capital towards securing the required capacity for the services that they offer their respective customers. And I think some of the notable drivers of incremental demand in the space include, the rising and widespread adoption of AI as a technology, cloud computing, 5G, and also just business and government entities, proactively transforming and upgrading their digital and IT infrastructure. But to give you a balanced view, Bernat, in response to the very strong demand backdrop, there has been an uptick in supply, right? That said, I think it's very, very important to note that the lion's share of the supply that is expected to be delivered in the foreseeable future is pre-leased, which means that the risk of the existing pricing power that incumbent landlords like Digital Realty have been enjoying is getting eroded, is largely mitigated. To underscore the strength of the demand that the sector is enjoying, Digital Realty, as an example, reported record leasing activity in 2024.
Cooks, we're almost done. Given all of this market uncertainty and volatility and inflation and interest rates and tariffs that we're trying to navigate, what is your outlook for the global listed property sector, and what are your closing thoughts that you'd like to leave with our viewers today?
Sure. I think we are in an environment where uncertainty is meaningfully elevated. And that said, I think global listed real estate as an asset class is uniquely positioned to navigate the associated headwinds, largely because of the healthy operating fundamentals that the sector is enjoying. And these healthy operating fundamentals are underpinned by a favorable supply-demand backdrop. So on the demand side of the equation, you have these secular structural tailwinds, as we have touched on some of them. For instance, in the single-family rental sector, you have these demographic shifts in the form of a growing cohort of aging millennials looking for affordable, bigger residential space. And then in the data center sector space, you have this widespread growth and adoption of technological advancements in the form of AI, which is, again, inextricably tied to the data center sector. And then if you look at the US industrial property sector, you have this government sanctioned onshoring of manufacturing capabilities, which is also expected to boost demand for industrial property. So all those secular demand tailwinds, which are less sensitive to economic cycles, are married to a muted supply growth outlook, which if you combine all those factors, present a very compelling story of resilience in an environment where there's heightened uncertainty. So at Catalyst, we are estimating a forward divi yield of about 4.5% for the sector, and cash earnings growth of about 5.6% over the next 4 years.
That's a nice total return package, right? Googs, thank you for your time, and all the best to you and the team during this very interesting time that we are entering.
Thank you.
Viewers, thank you for your time and for listening to our Q1 2025 Global Dashboard Insights. If you'd like to learn more about what we touched on today, please refer to the full dashboard, or alternatively, please reach out to me as per my contact details below. Thank you for your time, and goodbye.